mortgage rates and recessions. If you're worried about what a recession may mean to mortgage rates and perhaps the housing bubble, then this video is for you. Here's the deal. Yes, we're going to get a recession, my friends. How do we know? Well, 12 declining months in a row of leading economic indicators, inverted yield curves, so many signs, all signaling, pointing to a recession. Even the Fed is admitting that we are heading for a recession, and they never do this. So is this good or bad? Well, if you follow along with me, looking at the chart showing the history of mortgage rates during recessions, then here's what you'll notice. That the last recession, what happened? Mortgage rates went down 1%. Then look at the recession before that one, down again. And then you'll see something you might not know. How is the spreads between the 10-year treasury and mortgage rates have increased? This is because the market is thinking rates are gonna come down and will have impact on servicing values of mortgages. Because the value has been sucked out of them because no one is getting paid for servicing when they know that loans being originated today are gonna be refinanced. Obviously, the smartest money in the world see what we are showing you here. So they know that rates are gonna come down. They're not gonna pay for servicing, and therefore at these mortgage rates are not gonna have the benefit of a long-term shelf life. This is why the spread between mortgage rates and the 10-year treasury has increased. Okay, so the media is gonna likely say that a recession is horrible for housing, right? Well, however, what does that data say? The last 70 years worth of recessions, 8 of the last 9 times, home prices went up during and after the recession. Only one time, just once, that prices didn't rise. So what happened here? No, it was the housing bubble that caused a recession, not vice versa. So what caused a housing bubble? Just like anything else, it's supply and demand. It was too much supply and not enough demand. How do you measure supply and demand in housing? Well, supply is measured from builders completing homes and putting them on the market. That's your supply. A completed home, not one under construction. A completed home, that's your inventory. Demand is from households being formed. It's called household formation. So what is that? Okay, now let's imagine mom, dad, and a child. They live in one household. At some point, that child will grow up and move out on their own. So now it's the same family, mom, dad, and child, but instead of one household, they have formed another household. Son moving out on his own. The next chart will show you the both blue and gold bars. Blue bars, which are household formations for the past 20 years, and the gold bars are completions built by builders. Notice in 2004 and 2005, pretty darn close. But what happened in 2006? Builders built more homes than they have in history, 2 million homes. Yet household formations dropped off a cliff, and this disparity started to cause cracks in the 2007 housing market. Clearly an exacerbation of that, and by 2008, you had a full-blown housing bubble, and it was just terrible. If you want to know why the housing market has been so hot and prices have been going up so much, then let's look at what's happening for the past several years. You can see this area here. Too many households formed, not enough homes being built. That's why inventory is so tight. Now, when you take a look at this and say, okay, people are saying that they aren't afraid there's gonna be another housing bubble, well, let's understand what's going on. We know what's caused the housing bubble. There were too many homes being built with a lack of household formations. Basically, too much supply for the demand in 2006. But that started in 2007, 2008. And we haven't built anywhere near 2 million homes since then. We haven't even hit 1.5 million homes since then. And you can't blink and build a home. You must get construction time. Before that, you need to get approval time. Before that, you need planning time. Do we have enough water? Do we have enough schools? Do we have enough roadways, utilities? the grid for electricity. So much goes into planning, it takes years. So we know that because of the data. How many homes will be built and what it looks like in 2003. We're gonna have about 1.4 million households completed. Now I know what you might be thinking here. What if we saw household formations fall off a cliff? Could this happen? Could we see formations fall off of a cliff? That would be scary if it did, right? Well, this is tied to those first-time home buyers who are age 33. Now, there were a lot fewer of them first-time home buyers in 2006. Why? Well, maybe if we looked at the birth rates from 33 years ago before that, it would give us some clues. What was 33 years before 2006? Yes, 1983. What if I showed you birth rates from 1973? You'd have a huge drop in the number of births as a result. And that carried through 1974 before leveling out and then starting to recapture, which means 33 years later in 2006. Look at the pattern. It's amazing to see it hand in glove. It has to be that way. So when you are looking at 2023 and wonder if we will see household formations drop off a cliff again, we simply have to look 33 years back to 1990. A very big difference than 1973 and 1974. Would you agree? So we are not going to see a housing bubble. If you found this video helpful, please give it a thumbs up and share it with your family and friends who might be in the home buying process. Don't forget to subscribe to our channel for more informative mortgage strategy content. See you in the next video.